hello guys, and glad to have you on board again today. The topic is going to be trading the pullback, and not necessarily just all about trading it. This is going to be one of the major context analysis in here. This is one of the major pillars of the strategy. So if you read the PDF manual, which you're totally supposed to have done by now, you should understand that this is one of the key frames and key factors of contextualizing the strategy. So out of just figuring out what the pullback is today and how to trade it, what matters is you being able to highlight the pullback areas in charts, which means you're going to have to practice a lot into replay functions and stuff like that to be able to highlight potential pullback areas. Whether you trade them or not is not really what matters out there. What really, truly 100% matters out there is you being able to highlight those, because they're maturity, absolutely key points into trending behaviors. So if you're able to figure out the pullbacks, you're going to be able to fully understand what the market structure is, where you are right now in the possible trends you might be dealing with. And of course, these maturities will condition whether or not you can apply some of the trades that we're going to talk about later in this trending part of the coaching session in here. Okay, so for yellow guys into discords and stuff like that, there are plenty of trades I'm going to teach you later on into this series. But first of all, we need to contextualize stuff. So really important that you guys figure this one out. If you're going to have to look at this podcast multiple times, do it, but it absolutely is mandatory that you fully master the pullback trades when you get to trend trade or even trend follow and stuff like that. Going to be absolutely necessary. That's the reason why we do this one first. Okay, so today we're going to use another PowerPoint because of course that makes things a lot easier for you to follow. Let's get to it. Okay, let me just grab it on my hand. Okay. So as usual, we use this global thing in here because that's the actual endpoint of these coachings out there, is that later on, as you get to be learned all of the key elements of trends and range behaviors, you'll get to fully understand all the intermediate postures the market can take in each and every of those key points. So normally at that point, you already know these ones, the accumulation breakout, and you're getting to learn the pullback, which means you're going to terminate the structure of the easy context, the green one, which you should of course master at that point. So third range boundary plotting and trending third range boundaries should be mastered at that point. You should already get to know about the accumulation and pullback trade and the accumulation breakout trade, and we're getting to learn the pullback. But today we're going to have to talk about two intermediate postures as well, actually three of them that we're going to talk about but not necessarily dig deeper into, which means you're going to have to know a minimum about these, not necessarily, and most importantly, not even getting to try trading these, which is the intermediate context that will be associated to our market posture. Because in between the breakout trade and the pullback trade, you might have noticed the divergence trade. So we might want to figure out what the divergence is, not how to trade it. So I'll give you the big rules or big set of rules of how to figure out a divergence. It could be at play, not how to trade a divergence, because of course in order to trade we're going to have to need a risk management purposes and stuff like that, and we're going to get to these into only the experience context because they are freakingly complicated. Though the pullback is supposed to be following from the divergence and reaching out to final excess. So the same thing goes on in here, the final excess, which is definitely the hardest ever context to trade. Of course, you're not going to trade this one. You're just going to lock on your gains on the trend out of these areas. So don't try to look for the absolute market top. We're just going to look for the possible favorable conditions to lock on your gains, not getting the fuck out at the market top. We're not doing this yet, okay? And of course, the only trade we're going to add on this, because I said three contexts are going to be learned that are expert contexts. The third one we're going to talk about is actually the fourth range boundary, because we're going to need this one, okay? Because if you understood what the strategy is all about, it's a multi-layered time frame stuff. And as we said, trending time frames or trending context will always require understanding and processing three time frames at once. The indicator all by itself, framework, is showing you two time frames. Remember that the trend channel is the context of the high of the lower time frame, and so on. So you see two time frames at once with framework, and you need a third one. And as we said, on the accumulation and breakout trades, we're going to need to make sure that there is enough potential. So we're going to have a look at the third time frame on the higher time frame to make sure that we have enough potential. When it comes from the pullback trade, we're actually going to zoom in. Instead of zooming out to make sure we have enough time, enough space to break, we're going to in there make sure that we have quality signal on the lower time frame. Because of course, if you understand that type of a magnifying glass structure, everything is layered, okay? So what you see out there, okay, is no more than the same thing you have out there in a higher time frame, in the lower time frame. So actually what we look for in here is a mature range on the lower time frames, which could actually, if we were zooming into this area, would look exactly like that. So in here, this pullback trade is no more than a zoomed out version of a fourth range boundary. Okay, but of course the way we're going to be trading these is absolutely different, because I'm never going to teach you how to trade a fourth range boundary today. That's something we're going to get to talk about far later on in our coaching series. So what we're going to be taught today is how to highlight the fourth range boundary trading signal, and then how to profit from this on the higher time frame. What we're going to be doing is basically trading a fourth range boundary, but on the higher time frame. Though we're not going to trade it in the context, we're going to trade it within the trend channel. So what matters for us into the pullback trade is to trade within the trend channel's boundary. We're not necessarily going to be pullbacking in the context every time. Okay, so pullback is the only trade in the context strategy that will be dealt with specifically with the trend channel and not necessarily with the context. There will be a set of rules associated with context, which means there is no pullback if you are not at least closing into the lower 50% of the context, okay? So the pullback only exists if you are below 50% context. Some pullbacks will reach out to the context, some pullbacks will even reverse the context, but so many structures for pullback. Don't make it too straightforward out there. It's really can take so many ways to build a pullback. Okay, but what matters for us in here is that there are other sets of rules that we care about. Okay, so must be following a breakout, of course, that must have been validated and confirmed. Okay, which generally leads later on to the creation of a divergence, which is actually no more than a market oscillating between the the trend channel, not reaching the context, of course. Okay, the divergence never reaches out the support context. It's just oscillating into the lowest time frame context, still making higher highs and lower high points. The trend is still on, but that means generally that after the acceleration phase, the breakout phase, generally momentum is slowing it's slowing its pace. And basically the divergence creates momentum divergences. That's the reason why I call it that way, but that's not necessarily all about it. It's really considering it that way, that the trend channel is still bullish, prices are still bullish, but basically things are slowing down. So if you see this slowing down pace, you know that the probability for a pullback to occur is significant. Okay, so divergence is an intermediate optional structure, definitely not mandatory, but that also helps. So if you see the divergence, that's better stuff for you to trade the pullback. That means the trend needs to mature, needs to pose a bit to reload on some bulls to actually trigger one more time, reaching out the final excess later on. Okay, so we're going to need additional rules. So mature range on the lower time frame. Okay, fourth range boundary is required. We're going to have to deal with a Fibonacci cluster. Okay, remember that's a Fibonacci proximity. So the Fibonacci clusters for our trade are going to be typically minimum 23% Fibonacci. There are no pullbacks that trade less than 23%. Okay, so below 50% context is a bare minimum for a pullback. Minimum 23% Fibonacci is also a bare minimum for it, okay? You've got all those rules on the PDF manual. Remember that there's a page you need to print in which this actual stuff is into. So all of those things, I'll remember that there, okay? So minimum 23, 50% context below or below 50% context. Mature range, which is a fourth range boundary on the lower time frame, okay? Not necessarily trading this. You don't trade the fourth range boundary, but you must be able to figure it out, okay? And you're going to need finally a trending signal on this trend channel. Okay, so you don't trade in the context, you don't give a shit about the context, it will matter, but just in the risk management, and you need a trending signal on the trend channel. End of story, okay? So at least fourth range boundary, mature range, retracing down to at least 50% context and below, sometimes in the context, sometimes even below, but we need to be close to a 23 or 38% Fibonacci cluster. And we've got it. It's no more than that. It's not that complicated, but once again, this is to highlight a trade in a trading opportunity of a pullback, not necessarily trading it. Every context has a risk limitation to get to profit from this with a safe risk taking. So this is what we're going to be talking about. Risk limiting the pullback trade. Let's get into it. Okay, so first of all, we're going to take an example in here, which is the exact same thing that we've dealt previously. Okay, it's just follow through of our breakout stuff and so on. So previously out there, we had the breakout, which just kept on pushing. Okay. And finally, we got in here a pretty excessive market. So in here, we've got a clear example of a market that absolutely did not create a divergence pattern. It actually ended up roof breaking and going crazy parabolic stuff, overextended trend, which means it's gone excessive. Therefore, the pullback has been freakingly volatile, so volatile that it broke the context. Okay. It reversed the context. But what matters, remember, we don't give a shit about the context. Okay, the context is important though, but not what we care about. What we care about is the market oscillating within the trend channel for at least 4 times. So first range boundary, second, third, fourth. Okay, we've made 4 range boundaries within the context, within the trend channel, and actually within the context in here as well. So here is our 4th range boundary. But remember, what we care about is not the context. We look at the trend channel. Is there a signal out there? Shit, no, there is not. Okay, and in here we have one. We do have the triangle, which is a mandatory stuff. Okay, so here is our triangle or confirmation triangle. There is no highlight on momentum in here, but momentum in here was okay. So trending signal on momentum, confirmation on the trend channel. We've got everything we need to take the trade. So we get in after the close. So in here, that's a pretty bullish candle, which significantly deteriorated our risk reward ratio, but still we get in. Okay. We take the trade, and the next question is, where do we put the stop loss? What is the risk limitation for this trade? So in here, what I recommend is to use the size of the trend channel. Okay, that will give you an approximate size for a decent amount of risk limitation for your stop loss sizing. Of course, some specific cases of range, because like I said, range can take so many structures. Okay. And if you see that the trend channel is so narrow that the stop loss is basically so close to the actual entry price that it makes absolutely no sense, then you can double it. Okay, so in some specific cases, when the range that matured is so tiny in terms of trend channels width that you will like to double it. Okay, but most of the time, the approximate trend channel sizing will be good enough for you to put the stop loss. So in here, as we take the trade, we measure the context, we take its approximate size, that gives us a stop loss out there, right on the moving average, that's fine, okay? So we get in, we don't make things overcomplicated at that point. These types of trades are normal trades, okay? Remember that at that point, the trend is maturing, so we're not getting leveraged out there. We take a 1 to 2% risk taking on these trades, no more than that, okay? So stop loss is defined by the size of the trend channel. Next thing we care about is validation. The validation level will be set on multiple conditions. The first one being met is okay. Okay, so it depends on the structure of the range because there will be triangles, wedges, ABC, expanded wedges and stuff like that. So very, very unlimited amounts of forms in here to create these ranges. So we're going to use 2 sets of things to validate. The first thing is going to be reaching out the opposite trend channel. Okay, so in here, the trend channel hasn't even reversed. It remained bullish, so it's pretty far away from our prices. Though we're going to use another validation, which is at that point, you have 4 range boundary, which means you're going to be able to trace a trend line from the 1st to 3rd range boundary top points. So build your trend lines, and if you get to close the trend channel's time frame, okay, remember every time this trend channel is creating another step, means you closed the trend time frame. So when you make a trend time frame close on outside the trend line, trade is validated. Okay, no closing below or at the trend line. Closing above is absolutely necessary. Okay, or like I said, reaching the trend channel. That's the other way to validate. Confirmation comes from reaching out the context, okay? So in here, two options, depending on your assessment to risk. Either you just reach out in the context is going to be enough for you to confirm. Option number two, closing the context inside the context, okay? In that perspective, that would be just here, okay? Closing the context time frame inside the context. So either you take just reaching out or closing into, that's really up to you, okay? That's the safest option, the most aggressive option. Anyway, when you reach out, confirmation is the only way you can put the stop at break even. Just like we've stated previously for the trend following trades, if you put the stop loss at break even too soon because you want to be conservative with your money management, you're mostly going to destroy your risk reward ratios because you're going to be stopped out so many times, okay? So really wait for confirmation to put the stop loss, and like I said, either closing in the context or closing the context time frame in the context as a confirmation. Of course, as you begin with this strategy, I strongly recommend you to use the safest option instead, okay? But as you get confident enough with those strategies, generally, that's what I do personally, closing inside the context at least once or twice is generally more than enough to confirm, okay? The next step is taking care of our target area, which is, like we said previously, trying to figure out where the final excess shows up without, of course, trying to trade it to the opposite direction. So we don't sell the market out there, we just lock on our gains. The final excess being the end of our trending context means we take the fucking profits out there. Of course, there's some specific case scenario that we're going to deal with later when there are trends inside trends. In these perspectives only, we're going to alter today's rules. Otherwise, you just follow it. Final excess, take the fucking gains and 100%. Okay, there's no I take 50% and I leave it for the rest. No, you take the fucking money out. End of story. Unless specific cases that we're going to deal with later on. Okay, so final excess, how do we deal with it? Normally the market will make a new high. That's the first rule to check. So don't lock on your gains until the market is not making new highs. So making new highs and not just dipping a toe on higher territory. We don't want double top structures. They're so rare, you don't really want to care about that. So really need to marginally overcome the previous market top, overflow on top of it, and you generally want to look for market breaking on top of the resistant context. So prices on top of the previous market top, breaking or trading on top of the resistant context, and sometimes breaking cycles, okay? So in here anyway, you can see the market is lacking of breadth, okay? There is a squeeze of prices, you're on top of the resistant context, there is a signal from the algorithms, just get the freaking fuck out of there, okay? So that's how you deal with it. In here, you just lock on your gains, end of the story. The trend is likely going to terminate. Whether or not this is the actual market top is none of your concern because you're not looking at selling it. Okay? And the key element, finally, last but not least in here, like I said, the risk-reward ratio of a pullback trade mostly depends on the structures, because that depends on the size of the stop loss and on the distance of the profit taking. The most profitable structure as a pullback is the wedge structure, in which the market builds a downside wedge structure, compulsively shrinking the volatility to a very tiny level, in which you're going to have a tiny trend channel. So in that perspective, if the trend channel is so narrow that it requires doubling the stop loss sizing, please do it, because anyway, this trade is generally the most rewarding pullback opportunity structure, okay? The intermediate one, which is the most the most common one, is the ABC structure, in which the fourth range boundary generally dips below the second one, and you have this ABC flagging type of structure, okay? Otherwise, you have the triangle like we did in here, and you have some other exotic structures like the expanded wedge structure or any other stupidly more complex structure out there. And they can have so many infinite opportunities out there, so don't make it straightforward, don't make it too formalized, be open-minded out there. The range structure is mostly, we care about at least 4 range boundaries, dealing with this Dealing with the Fibonacci cluster is absolutely necessary. Don't blind trade in the middle of nowhere. Close to 23 or close to 38, nowhere else, okay? Absolutely mandatory. Don't forget that you trade the trend channel, not necessarily the context, but you need to be at least below 50% context. And finally, you need a trending signal on this trend channel, and possibly even better, get to have a look in the lower time frame to see if there is a nice signal on the 4th range boundary. Okay, which actually turned out to be there on our case scenario. So in this specific trade, we would be looking at the signals we've had on the lower time frame in there to assess our risk reward ratios, which means if we have a clear, nice bullish signal out there, we're probably going to risk 2% capital on this trade. If there is a really ugly taking profit structure or very, very mixed feelings and stuff like that, then we're probably just going to risk 1% capital. Of course, so you need to measure the risk taking depending on this, okay? The nature of the 4th range boundary signal quality is what's going to define your risk taking on this trade, okay? So in here, we're going to talk about another specific risk limitation that is assessed from some specific cases of pullback when the pullback is so volatile that it's going to reverse the context. When this thing happens, we're going to do something specific out there. Of course, risk off first. As you get to trade the trends, you need to secure the gains if there are some problems. In some cases like that will create volatile pullback, volatile enough that it will reverse your context boxes, okay? We care about the trend channel, but if the context gets reversed in the process, which is the case in here because of huge volatility, lock on your fucking gains on the 3rd range boundary of the context time frame, okay? So when you retrace to the context in here, which means you're creating a bigger time frame pullback, okay? Normally the pullback set itself within the trend channel, but sometimes it will create itself within the context in the same time. If that occurs, take the fucking trend gains on the 3rd range boundary. At that point, you still haven't took the pullback trade, which is going to come up later on, okay? But in that perspective, all the previous trades, the accumulations, the breakout, and all the possible intermediate lower time frames trades I'm going to teach you later on in this series, you need to take them out 100%. Okay, it's no 50% secure. You take the fuck out of here, these gains, and you still can trade the pullback. Okay, so think about profit taking your trades. Don't be dumb enough. If you're really confident into the trend continuation, eventually lock on at least 50%, but required in here at least 50%, up to 100%, which is the safest option. You never trend follow again after that point. It's way too dangerous to apply the trend follow opportunity in here. The only trade you can take afterwards is the pullback, and only if it gives you reliable trading signals to follow it. Otherwise, not trade anymore. You take the profit on the 3rd range boundary, end of story, and you get the fuck out of here, okay? That's absolutely necessary that you understand the specific case scenario. When a pullback reverses the context, just make sure you lock on your gains on the 3rd range boundary that follows later on, okay? You still can trend follow at that point, but only with the pullback trade. You no longer apply the trading context I will teach you later on in this series, okay? That's it. Now we have more than enough information to go conclusion. All right, so if I have to sum up the core information of this pullback trade, first things to understand, don't necessarily trade it. What matters is for you to formalize this pattern into your brain, to put it into the right place. What matters is you figuring out that trends have different maturities, and the pullback is very crucial one into trend follow stuff. It puts an end to the previous trending behaviors. So you're not going to apply the trend follow trades at that point. When the pullback shows up, it is the last time you trend follow. Afterwards, no more I'm calling for the pullbacks and stuff like that. The things I'll teach you later on. No more than that. The pullback is your last trend follow trade. Still, the trend is normally supposed to still exist at that point, and you will reach out to the final excess when you lock on all the gains, unless specific cases that I'll teach you later on. Otherwise, Don't forget about the specific case scenario in which the pullback reverses the context. If that happens, then lock on your fucking gains on the third range boundary. You can still trade the pullback later on, but lock on all the previous gains, or at least 50% of them, on the possible third range boundary. Otherwise, you're taking too much risk into this trend. Reversing the context is a sign of weakness, which means sometimes trends will reverse without pullbacking and stuff like that. And this is why you will secure the gains on those trades. Okay, always go for the safest option, at least 50%, or take it all out. That's what you need to do. Okay, finally, if you want to trade the pullback, it really needs to occur specifically on the clusters of either 23% or 38% Fibonacci. Don't ever trade in between the two. Of course, don't be stupid enough to trade perfectly the 23% or perfectly the 38%, considering it an area of interest. Okay, you need to have a mature range on the lower time frame, clearly visible 4 range boundaries, the nature of the 4th range boundary signal that should be on the chart when you trade, because you're trading on the higher time frame. Okay, so normally the signal should already be there and close for several candles on the 4th range boundary. The nature of this signal is what defines how much risk you take. If you want somehow of a window, you're going to take between 1 to 2% risk on capital. So if you have a clear and nice 4th range boundary signal, take 2%. If the signal's pretty mixed, go down to 1 or 1.5%. Okay? If you have absolutely no signal on the 4th range boundary, really take the lowest possible odds out there, 1% risk taking. But if you have your signals on the trend channel, which is the high time frame, you don't nearly give a shit about the fact that there are no signals on the 4th range boundary. Like we said, it is a necessary, it is a good condition that will increase your probability of success, but that's not something mandatory. Just like if you don't see the divergence, fuck it. That's not necessary either. That's a good point. Having a divergence, having a clear and clean 4th range boundary signal on the lower time frame is a good point that will help you risk taking up to 2%. Rarely you should go above that, so 2% risk taking is really a decent amount of capital investment for these types of trades. But most importantly, don't forget that as they show up, no more trend following later on. That's really the absolutely very important and crucial point, which means that even if the pullback trade doesn't trigger just because you don't get the trading signal or stuff like that, still means if you've retraced 23%, if you have gone below 50% context, and if you've had at least 4 range boundary on the lower time frame, means the pullback occurred. You didn't necessarily trade it, but at that point, no more trend follow. That's really what matters the most into today's perspective and podcast. Okay, so quick recap out there, and really make sure that you understood the key elements of today. It's not necessarily about trading it, really not about it, but being able to highlight these. So make a lot of practice, take your charts, use the replay functions and stuff like that, and try to figure out on each and every breakout and trend that you might see on your charts, are you able to highlight the pullback points in which there is a clear and evident maturity level of trends that you need to master and be able to figure out on each and every trend you see. Some trends have no pullback, of course, because nothing is ever 100% guaranteed, but normally most of the trends do create the pullback. Okay, so try to practice this, try to be efficient in highlighting the final excess as well, but don't remember that if you try to gather the market top, if you try to push your gains right up to the tipping top of the trend, it's generally when you're going to get a huge reverse and going to be stupidly triggering your stop loss, your taking profits on the downside movement, which is stupid. You rather like to take your gains when the market is trying to accelerate rather than trying to chase down the market top, which is something that we're going to try doing when you get expert into trading, and these things we're going to deal with them much later on into your coaching progress. That being said, I wish you guys a pleasant day. Later.